Hi again, VITA volunteers. In this lesson, we will begin our discussion of credits, and specifically we're going to cover credits for children and other dependents. To get to this point, we covered filing status and dependency determination, income and adjustments to lower income, which ends with the adjusted gross income line, which is going to be important for some of the credits in this lesson. We also covered deductions that further lowered the taxable income, and then we talked about the tax calculation. So credits, unlike deductions, they don't lower the amount of income that is subject to tax. They lower the amount of tax due directly, which is why they flow onto the 1040 after the tax line on page 2. Now, if you remember way back to our filing basics lesson, we talked about two different types of credits, non-refundable credits and refundable credits. And if you'll remember, non-refundable credits, they can lower the amount of tax down to $0, but no further. Once we reach 0, it's done. Refundable credits, on the other hand, can not only reduce the tax down to 0, but even beyond that, which can lead to greater refunds. So in this lesson, we are going to see both types.
So I just want to make clear, when you go on to Link and Learn, there's a separate lesson for the child and dependent care credit, and then the child tax credit and the additional child tax credit and the credit for other dependents are together as one lesson. So that's how those lessons are divided out when you go over to Link and Learn.
Let's begin with the child and dependent care credit. Last year, this was one of the credits that had some fairly significant changes in response to COVID. However, those changes were only temporary and have not been carried forward for the 2022 tax year. We do need to be familiar with last year's benefit, though, in case someone comes in needing a prior year return prepared. And anytime a tax benefit becomes less beneficial from one year to the next, we can expect that our clients will ask questions about why they aren't getting as big a refund as they may have been expecting. So we need to be prepared with an explanation. In 2021, temporarily, taxpayers could get up to 50% of qualifying child and dependent care, such as daycare expenses, reimbursed as a credit. The limits were up to $8,000 for the care of one qualifying person and up to $16,000 if the taxpayer were claiming 2 or more qualifying persons. And last year only, this credit was refundable, meaning taxpayers might be able to claim the credit even if they didn't have any tax or a lower tax than the credit amount. For 2022 returns, though, the credit is returning to the way it was before COVID. Now, taxpayers, depending on their adjusted gross income and earned income, may be able to claim between 20 and 35% of their qualifying expenses toward maximums of $3,000 for one qualifying person and $6,000 for 2 or more qualifying persons. It's important to note that the expenses for 2 or more qualifying persons do not need to be equally distributed if, for instance, the care of one qualifying person was over $3,000 but another qualifying person's care was less. And now that the credit is reverting back to a non-refundable credit, meaning taxpayers can reduce the tax on line 16 of the 1040 down to 0, but once they have done so, they would not be able to get any more credit, even if they otherwise qualify for more.
So in order to claim this credit, there are going to be 5 tests that our taxpayer has to pass, 5 hurdles. So there's the qualifying person test, there's the earned income test, the work-related expense test, the joint return test, and the provider identification test. So let's kind of take these one by one and see what they mean. Our qualifying person test refers to the person that our taxpayer is trying to claim they had expenses for. So there's kind of 3 categories. One category is a qualifying child. And this qualifying child needs to be under the age of 13. They need to be claimed as a dependent. And if this is a situation where we have divorced or separated parents, this is not one of the credits that can be transferred to the non-custodial parent. Only the custodial parent can claim this credit. And they can still claim the credit even if they have transferred that dependency to the non-custodial parent in that year. The second set of people who qualify as a person for this test are people who are physically or mentally incapable of self-care. Again, they would be claimed as a dependent. And if they are not claimed as a dependent, the only reasons why they were not claimed were due to the gross income. So if you remember, we might have a qualifying relative who has a gross income of, well, they would have qualified for qualifying relative, but their gross income was too high. It was over the $4,300, in which case our taxpayer wouldn't be able to claim them, but they would still be able to use them as a qualifying person for this test. Again, the same idea if the person is not able to be claimed because they are filing a joint return with somebody else, or the taxpayer or a spouse is a dependent. And this is a sort of a situation where you might think of like a parent, where somebody is paying for care of a parent. Another group of people are a spouse. So as you recall, you can't ever claim your spouse as a dependent, but you might be able to use them as a qualifying person for this credit if, again, they are physically or mentally incapable of self-care and they lived with the taxpayer for more than 50% of the year. So then we move into the earned income test. And in this case, the taxpayer and the spouse, if they are married, must both have earned income during the year. And so for the purposes of this credit, earned income includes wages, tips, salaries, other taxable employee compensation, net earnings from self-employment, and disability pay reported as wages. If the spouse is a full-time student or if they are unable to care for themselves, then $250 each month for one qualifying person can be allocated as income for that spouse. Or if there's two or more qualifying persons, that amount that gets allocated as earned income would be $500 each month. So let's shift our attention now to the expenses. And the qualifying expenses need to have been work-related. So they need to have allowed the taxpayer and spouse, if married, to either work or look for work, or in the case of a full-time student, that counts as well. The expenses also need to have provided for the qualified person's well-being and protection. So if we look at what that means, expenses could include preschool or home daycare for children who have not yet entered kindergarten. After they've entered kindergarten, it would be before or after school care. In the summer, it could be for a day camp. In the case of more often thinking about like a spouse or a parent, it could also be amounts paid for a housekeeper or a cook if at least part of the expense was for the well-being and protection of that qualified person. So things that it does not include are education expenses for children who are kindergarten and above. So for instance, after school care counts, but if you are hiring a private tutor after school, that does not count as a qualified expense for this credit. And additionally, while day camp would count, an overnight camp would not count. The joint return test says that married couples must file joint in order to claim the child and dependent care credit. The exception is for persons considered unmarried, which we talked about before in our filing status lesson. Under certain situations, a married person would be considered unmarried if they haven't resided with their spouse for over 6 months. And usually in that case, the reason why they're considered unmarried is so they can file head of household. Just kind of the general rule of thumb with this credit is if they're married filing separate, they cannot claim this credit. And our last test is the provider identification test. And if you remember, we talked a little bit before about the income matching program that the IRS has. And so this is kind of part of that. So if people are claiming this credit, the IRS wants to know some information about the provider who should be claiming the income. So the things that we need to have in order to claim this credit are the name of the provider, the address, and the tax identification number. So that would be like a social security number if this was an individual, or an employer identification number if it's a organization or facility.
On to the child tax credit and the additional child tax credit, which is a credit for certain qualifying children. However, not all qualifying children will qualify for this, and we'll discuss more of that in the coming slides. The child tax credit was another credit that had significant changes in response to COVID for 2021 returns. In that year, each claimed child aged 6 through 17, that means including children who were 17, could qualify the taxpayer to a $3,000 credit. Each claimed child under the age of 6 could qualify the taxpayer to a $3,600 credit. In many cases, half of this was paid in advance, and especially with our main client base, this credit was fully refundable. Some high income earners it wasn't, but again, for our client base, it was fully refundable. For 2022 returns, however, this credit reverts back to its pre-2021 conditions, which means that only children under 17, so not including children who are 17 at the end of the tax year, will qualify the taxpayer for $2,000. There was no advance payment, so taxpayers only receive this when they file their return, and it's only partially refundable. That is, the child tax credit itself is non-refundable, but up to $1,500 of the credit can be claimed through the additional child tax credit as a refundable credit if the taxpayers reduce their tax down to 0. So let's talk about who these children are that are qualifying children for this credit. Most of the tests are the same as the dependency tests for a qualifying child, but there are some important differences. We still have the relationship test, so these could be children, siblings that are younger than the taxpayer, and any descendants of those relationships, including any half or step relations. We also have the age test, but now only children under the age of 17 at the end of the tax year can qualify for the credit. The residency and support tests are the same as the dependency tests, but the child must be a U.S. citizen, U.S. national, or resident of the U.S. So residents of Canada or Mexico don't qualify for the credit. And the child must have a valid Social Security number. There are some income phase-outs for this credit, and they are based on modified adjusted gross income, or MAGI. meaning that we take the adjusted gross income and modify it by adding in certain adjustments or excluded income items. I won't go over what the modifications are here because, for one, TaxSlayer will automatically calculate this, and for two, we just really don't see it based upon the clients that we serve, because the MAGI limits for married filing joint taxpayers are $400,000 and $200,000 for all other filing statuses. You might note, though, that in 2021, the MAGI limits were lower to receive the additional tax benefits of that year. If taxpayers were over those thresholds, then they would revert back to the usual rules, which are the rules for 2022. In brief, that reduces the credit by $50 for every $1,000 in income over that threshold. And the credit will flow through onto Schedule 8812, the credits for qualifying children and other dependents form. You'll see Part 1 there is the child tax credit and the credit for other dependents, which we'll talk about in a second. And then there's Part 2 for the additional child tax credit, which again, if the taxpayers have reduced their amount of tax down to zero and they can't use all of their child tax credit, then $1,500 of that child, up to $1,500 of that child tax credit could flow into that additional child tax credit as a refundable credit. And as we talked about a little bit earlier, for 2021 returns, taxpayers may have received up to half of that credit ahead of time as an advanced payment, which meant that there was a reconciling process when they went to file their returns. And so if we see some people coming in who need to file their 2021 returns, we're going to have this reconciling process. They should have received letter 6419 from the IRS that would show the amount of the advance payment for 2021. If it's a married couple, each couple would have gotten a separate letter, and each letter would report half of the credit amount and the advanced credit amount. So if we have a married couple, we should be seeing 2 letters. If our taxpayers don't happen to have those letters, or they don't know for sure how much they got in advance, or if they got anything in advance, we can always help them log on to their accounts with the IRS and find that information out in their IRS account. Again, the credit flowed on to Schedule 8812, but the form was a little bit different. There was this Part 1B for filers who received some of the advance credit, and line 14F was where they would report that. And in the 2021 software, there are screens to input the amount that was received in advance.
Now, there are a lot of dependents that don't qualify for the child tax credit. Certainly, we have our qualifying children who are over the age of 17, and we have our qualifying relatives. In that case, there is the credit for other dependents. And in order to qualify to get the credit for other dependents, the dependent must be a U.S. citizen, a U.S. national, or resident of the U.S., so that's the same. But we have a little more room with the tax identification number. So in this case, they can have a Social Security number, but they can also have an ATIN or an ITIN. The credit's not quite as generous as the child tax credit. We only get $500, and it's non-refundable. So if our taxpayers owe less than the amount of credit in tax, they only get up to the amount of tax that they owe, and then anything above and beyond that is just lost. So it's not quite as generous. They won't be able to get more refund than what tax they owed on this credit. I wanted to finish up by looking at the 1040 again, and we're on page 2 again. And if you'll remember our last lesson, we stopped off with line 16, which was the tax. And the next couple of lines are adding in a little extra if there's other taxes that need added in. For this lesson, the first line that we're looking at is line 19, non-refundable child tax credit or the credit for other dependents. So remember that was non-refundable. So the next few lines take us through a process where we can subtract the amount of non-refundable credits from the tax down to 0. But you can't subtract and get a negative tax number at this point, or any kind of extra refund. It can only take the amount of tax that was calculated from taxable income down to 0. But you'll notice that down a little further we have our line 28, which is where the refundable child tax credit or the additional child tax credit shows up. So if you remember, our child tax credit this year may be fully refundable for a lot of our clients, or if their income was a little higher, it may be only partially refundable again. And in this case, it's a little different. Our taxpayers' tax could be subtracted down to 0 and then beyond. So if they have more of these refundable credits than they had in tax, then they would get a refund and they would be able to get more back than they would have had due based on their taxable income.